Dear students and fellow forex traders, I have a technique which I'm going to share with you with the help of this diagram. In the next few minutes, you're going to learn how to identify the hidden support levels that are going to absolutely skyrocket your confidence and, most importantly, your ability to analyze the forex market. No shortcuts, no gimmicks, and without further ado, let's do this. So we are going to start with day one. Day one is the foundational candle. This is the 3-day pattern. You're not waiting for 3 days, but you are analyzing the movements of the past 2 days and you're placing your trade on the 3rd day. So this is day one. Open, close, high, and the low. This is the lowest part of the candle. That's the highest part. It's a bullish candle. This is where it opens. This is where it closes. And now you have the day 2 candle. The day 2 candle must close above the high of the first day. Once again, the close of day 2 has to close above the highest point of day 1. Once that happens, then you can draw out your hidden support level. Okay, this is the lowest part of the day. That's the open, that's the close, that's the highest point. If it was just the high, which wicked above the highest point of day 1, that is not valid. The way to find these support levels is to make sure that day 2 closes above day 1 high. Once that happens, that's when you draw out your support level past the body of day 2 into day 3. Day 3 is when you are going to be placing your trades. The only thing that you need to identify in day 2, apart from the close of day 2, is the demand zone. This demand zone is crucial because that is going to be your springboard from where the price is going to move from after a liquidity grab. Okay, so you must identify a demand zone from day 2, within day 2. Draw it out into the future and wait for the price in day 3 to react from this level. This is our day 3. The price opened above the support level. Okay, if you analyze the forex market, especially on the European pairs, okay, the beginning of the day typically starts and it ranges. That range is accumulation. Accumulation simply means that the price is going in a sideways motion and it's accumulating orders, and during the London session the price is typically going to grab liquidity by going either to the south or going to the upside. So in this scenario, once the day opens in day 3, this is day 3 candle, we have accumulation, and then price dips to the downside. This move to the downside is a liquidity grab typically, and this liquidity grab is going to go into your demand zone, which you have already identified within day 2. Once you see that happening, you place your trades from around this level. Price did 2 things. Price reacted, price dipped into this hidden support, okay, and it also dipped into this demand zone. It also grabbed liquidity on its way down. It did 3 things. Number 1, after we opened, the price reacted from the hidden support, which we have drawn out. 2, price reacted from the demand zone, which we have drawn from day 2. And 3 is that price also grabbed liquidity on its way into the demand zone. We place our entries from the demand zone from around this section, wait for an engulfing or a pin bar, and then we buy the price. This is a bullish example, so it is going to be a support, but the same thing happens for a resistance. Just flip it, it's just going to be the same thing. Price action is all about learning and understanding the patterns that happen. Okay, this pattern has happened a million times before. All you have to do is backtest, find situations where this has happened, and then wait for it to happen in the future. You do not have to trade everything. You need to find your edge. Once you find your edge and you understand what you're comfortable with, then you just follow that path going forward. So I place entries on a 1 hour time frame, 1 hour, sometimes 15-minute time frame. Then once it enters from this level, price is going to go to the upside in an impulsive move. This is the highest point, and this is the close of day 3, and that is your profit. Now we are off to the live market. Let's go. So there we go. This is day 1, followed by day 2. As you can see, the close of day 2 closed above the highest point of day 1. So we go to this level, go past day 2 into day 3, just like that. This is going to be our hidden support level. This is our hidden support level. Each candle is a daily candlestick. This indicator which I have on it is called the high-low day box. It simply marks out and highlights the high and the low of each day on all the time frames. Now we're going to drop down to 4H. On the 4H, remember, we need to identify a demand zone. That's our demand zone right there. We've identified it, demand zone. Okay, that's all we need to do here. So that's our hidden support level, backed by a demand zone. Now we are going to drop down to 1H time frame. So this right here is our Asia session. This section right here is our Asia session. This range is our accumulation box. Price consolidates, accumulates by going sideways. This is EuroCAD, so it is a European pair. The Asia session is typically going sideways, price goes sideways, and during the London session, price dips to the downside, grabbing the liquidity, grabbing the sell side liquidity, trapping the people who have entered the market early, and going into our demand zone, past our hidden support level, and then once price reaches this level, we look forward to placing our entries. That's the dip. Once that dip happens, it actually grabs liquidity from the Asia session right around here. Everybody who entered the market early was stopped out. This is the liquidity grab to the downside. All we need to do now is wait for time to enter the market. Jump down to 15-minute time frame. We are seeing that we've got an engulfing. Once we get that engulfing, we place our stop loss a little bit into the zone, aim for a minimum of 3% at least, just like that, and wait for the price to do its thing. There we go. Another useful thing that you can do in order to give yourself even more of a confluence is to get your Fibonacci retracement level. So as you can see, price actually rejected the level in between 50% and the 61% Fibonacci retracement level. If you want to know more about the Fibonacci retracement tools and how I utilize it in my strategy, then all you need to do is click the video on the screens right now. Do not forget to like, comment, and subscribe. I'll see you guys in the next one. Take care.